The NASDAQ 100 has created insane wealth. We're talking years with nearly 100% returns. It seems like everyone is getting FOMO to buy this index because the returns have been just so good. But did you know this same index also crashed 83%? What would you have done if you had to wait nearly 15 years just to fully recover? This QQC deep dive will tell you everything you need to know to decide if this Invesco NASDAQ 100 Index ETF is right for your portfolio. And you surely don't want to miss the risk section of this video where I discuss what no one is talking about: the psychological reality of holding an ETF like this during a market crash. This is a deep dive you cannot afford to miss. Let's do this! Welcome to the Mr. Financial channel. I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on social media hype. If that's your vibe, subscribe. Let's start with an overview of QQC before we discuss in detail the amazing performance. What is QQC? It is the Invesco NASDAQ 100 Index ETF. This Canadian-listed ETF currently holds the US-listed QQQM and has no currency hedging. The index consists of the 100 largest non-financial companies listed on the NASDAQ stock market based on market capitalization. More on the index later. This Canadian-listed ETF was launched in the middle of 2021. It has almost $1.8 billion in assets, though it was $2.6 billion just 2 months earlier. QQC has a 0.3% yield and small quarterly distributions. It has an MER of 0.21% and no TER. Basic information like this is found on the main page of Invesco's QQC. There you have quick access to other essential documents you'll need. Obviously, nobody buys a NASDAQ 100 ETF because of its MER or quarterly distribution. People buy QQC because of the performance. And honestly, the return history of the NASDAQ 100 is somewhere between incredible and completely insane. Here's the pertinent data when it comes to QQC's performance as of April 30th, 2026. Since inception, it has returned 18.5% annualized. That's amazing. But we have to remember the time frame we're speaking of in this situation. This fund has less than 5 years of data. We'll look at the index a little later for more context. Over the last 3 years, QQC has returned 28.2% annually, which is mind-blowing, trailing the index in CAD dollars by 40 basis points. And last year, it returned 38.7%, which sounds amazing until you remember what was happening this time last year: tariff wars. If you jump back just 2 months, the 1-year return drops to 12%. Again, this highlights how timing plays a large part in looking at historical performance. We need to keep it in the right context. Tech can come in and out of favor faster actually, than I can get in and out of my underwear. Turn your attention to the calendar year performance, where you'll get an idea of QQC's variance in returns. I mentioned the fund has returned 18.5% annually, but look at that year to year. In 2023, 51%, 24, 37%, but in 2022, negative 27.5%. The fund has such a small history, and yet we already get a sense of how volatile QQC is. I'll be circling back to this at the end of the video. And as I usually do in my deep dives, let's add some color to the performance by looking at the index return using annual and monthly returns, as well as rolling returns. The NASDAQ 100 Index annual returns have been, for the most part, positive and sometimes crazy positive. In 1998, the annual return was 85%. In 99, nearly 99%. Then we had the dot-com crash with 3 consecutive years of mid-30% crashes. There have been 6 years of over 50% annual returns and 14 years of over 30% returns. This sounds exciting and may get your eyes only seeing green. But the index has also had 1 annual return of negative 42% in 2008 and 7 years of negative 30% returns over the last 55 years of data. It isn't any smoother looking at the NASDAQ 100 Index monthly returns either. This is what it looked like building up to the dot-com crash. Double-digit monthly gains were common. During the crash, though, double-digit monthly losses were common. How would you feel watching your portfolio drop by 22.9% in November of 2000? and then dropping again by 26.2% just 2 months later. The recovery saw ridiculous monthly gains as well. Anyone thinking they could time going in and out of the index was playing a fool's game, wouldn't you agree? And the great financial crisis was no different for monthly returns, albeit nowhere near as drastic. Seeing your portfolio drop month after month in double digits is very tough to stomach. I'm sharing this to show the realities of holding this index through recent history. Let's change perspectives a little. What you're looking at right now are various rolling return periods and where the return landed. 1-year returns will show the most variance. There were 15 periods of 40% or more losses out of 409, or about 4% of the time. At the same time, there were 72 periods of 40% or more gains, or about 18% of the time. All returns, approximately 20% of 1-year rolling returns, were a loss. Now, by 10-year rolling returns, we're looking at 14 periods of 40% or more losses out of 301, or about 5% of the time. At the same time, there were 265 periods of 40% or more gains, or about 88% of the time. In total, there were about a 91% win rate over 10 years. So in the short term, the losses and gains can be immense. In the long term, the variance reduces. We can really see this in the annualized rolling returns of the index over the last 55 years. Just look at the extremes of the 1 year. 67% loss to 125% gain. By year 15, there were only positive periods. And by year 30, the extremes become a lot narrower and closer to the current rolling return of 30 years. Now, put yourself in any one of these 1-year rolling returns since 1971 that were negative. How would you feel? The negative returns show up in bunches, 8 of them. Starting to invest and then living through that is psychologically challenging if you are not prepared for it. Even when you are prepared, it's difficult to hold a highly volatile index like the NASDAQ 100. Even when you know the performance has been just phenomenal historically, when the negative period just drags on and on, you could be tempted to bail just before the turnaround. The 5-year rolling returns are starting to look easier to handle, but still, to hold for 5 years and still be down huge is rough. You really need to know your risk tolerance and capacity. The 30-year rolling returns shows me why we need to have a long-term outlook when investing. Sure, the annualized returns still oscillate. However, the band is much narrower. And now let's take a look at the management's report on the fund's performance at the end of 2025 for QQC. Do you see in the annual compound returns that the non-hedged and hedged ETF is underperforming the index? This is in part due to the 0.21% MER. However, there is also the tracking error to take into consideration. In 2025, it was sitting at 0.16%. The 1-year difference between CAD hedged QQC.F and the non-hedged QQC is quite substantial at 3.6% in favor of the hedged fund. However, since inception, the non-hedged QQC is ahead by about 37% since inception. I'm giving all this detail on the performance to give a more holistic and complete picture of QQC and the NASDAQ 100 index performance as a whole. It's easy to get sucked into the FOMO of an index that is doing extremely well recently. By the way, if you appreciate deep dives that go beyond surface level ETF hype, hitting the like button genuinely helps this reach more DIY investors. Thanks for doing so. Now back to the video. Now, after seeing all those explosive returns, you might assume this ETF also generates a lot of dividend income. Shocker, it doesn't. And that actually tells us something very important about where QQC's returns are really coming from. As I mentioned at the outset, QQC has a tiny quarterly distribution of 3.8 cents with a yield that currently sits at about 0.3%. Obviously, the majority of its return is from unrealized capital gains. This is a good thing, since it will delay tax owing in a taxable account until you sell the ETF. If you look at the year-to-year income summary, the majority of the distribution has been foreign income. Some years, there is a lot of capital gains or a small rock of less than a cent. That's what happens when there's portfolio turnover. Last year, it was 17.1%. In 23, it was 51%, and that resulted in 61 cents of capital gains. Because the NASDAQ 100 has next to no dividend income, that means QQC has so little foreign income that the withholding tax is basically a non-factor. It was 2.8 cents in all of 2025. It shouldn't be a much concern to Canadian investors looking to invest in the NASDAQ 100 with QQC. But distributions alone don't really tell us how this ETF behaves underneath the hood. For that, we need to look at the factor profile, because this is where QQC starts revealing its true personality. This is what Morningstar's factor profile looks like as of the end of March 2026. For a US large cap growth index, you should expect to see the portfolio tilt into growth, large size, and high quality. And we already knew the low yield from looking at the distributions. What stood out to me the most was the range that the momentum factor has displayed over the last 5 years, from high to low. If you look at just the 1 year, it stays in the high momentum range. The 2022 bear market really had an impact on the fund's factor profile, and it shows what a momentum-like fund QQC behaves like. And once you combine that momentum exposure with the current valuation metrics, you understand why some investors are extremely bullish on the NASDAQ 100 right now, while others think expectations may already be getting dangerously high. So is QQC a deal right now? To answer that, we have to look at the PE ratio, or price to earnings ratio. The current PE ratio for QQC is 36.5. Compared to the US market at 26.7, QQC looks expensive on a PE basis, even after all these great earnings reports coming in. But expensive doesn't automatically mean poor returns in the future. However, as we noted before, price fluctuations are common. Earnings can fluctuate. So when looking at data on performance, distributions, value, and so on, they're all backwards-looking metrics. We don't know what the future will hold. Historically, these high PE ratios have been around for many years now and have not abated since the mid-2010s. Time will only tell. Now here's where the concentration story really starts becoming obvious. Even though QQC holds around 100 companies, a surprisingly small number of stocks are driving a massive portion of the returns. QQC holds one US domiciled ETF, QQQM, which holds 103 stocks. Similar to the S&P 500, where only a handful of mega cap companies dominate returns, QQC is even more concentrated. The top 10 holdings make up 50% of the fund, and the top 20 make up 68.4% of the fund. The top 10 are dominated by the big names like Nvidia, Apple, Microsoft, Tesla, Amazon, Google. The bottom 10 companies make up just 1% of the fund, and the bottom 20, just 2.7%. This is a modified market capitalization ETF, or MCAP. So this fund is really dominated by the trillion-dollar companies in the index, and that's why Nvidia makes up 9% of QQC. At first glance, many investors assume QQC is simply 100% America, but the geographic exposure is actually a little more nuanced than most people realize. Before I show you the geographic breakdown, do you know if the NASDAQ 100 is US companies exclusively? Here it is. 97% US, 1% CAD in Netherlands, and a bit of Brazil, China, and the UK. This is different from the S&P 500 or some other US large cap growth funds, and it has to do with the index construction that I'll get into in a minute. So this is clearly a US large cap growth bet. Once you combine the geographic exposure with the sector breakdown, you really start seeing how aggressive this ETF actually is. This is not broad market diversification. This is a very concentrated bet on innovation and technology. Is it any wonder that the sector exposure looks like this? 64% tech, 20% consumer discretionary. QQC represents 10 of the 11 sectors of the market, specifically excluding financials. Looking carefully though, real estate, energy, basic materials, and utilities make up next to nothing. 6 of the 10 smallest sectors have less weight than just Nvidia. At this point, the fund style probably won't surprise you. QQC is essentially the textbook definition of large cap growth investing. There's no surprise here, as an MCAP, large cap growth index. The fund style is large cap growth, with 35% of the fund large cap growth and 39% large cap blend, with only 15% in large cap value. It has about 11% exposure to mid caps, with 4% of that growth. Looking at the market cap size breakdown, Morningstar has QQC at 54% giant, 34% large, and 11% mid cap. Just to put this into perspective, though, the average market cap is nearly $1 trillion. Now, to really understand why QQC looks the way it does, we need to understand how the NASDAQ 100 is actually constructed. Because this index operates very differently from something like the S&P 500 index. The NASDAQ 100 index includes securities of 100 of the largest domestic and international non-financial companies listed on the NASDAQ stock market, based on market capitalization. The index reflects companies across major industry groups, including computer hardware and software, telecommunications, retail wholesale trade, and biotechnology. It uses a modified market capitalization weighted methodology, meaning larger companies get bigger weights, but NASDAQ applies caps and rebalancing rules to prevent a few mega cap stocks from becoming too dominant. I won't get into the nitty-gritty here, but the big thing to know is that at the annual weight adjustment, no security may exceed 15% of the index. And to qualify for inclusion, companies must have been listed on the NASDAQ for at least 3 full calendar months before the annual reconstitution. The NASDAQ 100 also requires 200 shares per day over the last 3 calendar months to meet inclusion requirements. Additionally, there are certain types of companies that are fully ineligible for inclusion in the index. All companies classified as financials, of course. And within the real estate sector, any companies classified as REITs are ineligible, and SPACs are ineligible. The index is rebalanced quarterly and reconstituted annually. Because it's heavily concentrated in technology and growth stocks, it tends to be a lot more volatile than the S&P 500 as an index. One important thing to remember when comparing the NASDAQ 100 to, say, the S&P 500, the NASDAQ is rules-based, and inclusion is not made by a committee like the S&P 500. And honestly, everything we've discussed so far, the concentration, momentum, growth exposure, and valuations, all leads into one unavoidable topic: risk. Because the incredible returns of the NASDAQ 100 did not come for free. QQC and its underlying ETF QQM has a risk rating of medium to high. That means its standard deviation can be anywhere from 16 to less than 20. We saw reviewing QQC's annual performance and rolling returns, it has had massive swings. This is what we intellectually understand. This higher risk means higher returns and massive price swings. The question we need to ask ourselves is, can I mentally tolerate it personally? Can I financially tolerate it? And for how long? For example, the NASDAQ 100 index had a max drawdown of 83% in 02, negative 60% in 74, negative 40% in 87, and most recently, negative 35% in 2022. Think of this underwater plot graph as the pessimistic view of the index compared to the performance chart that shows a positive view. And remember, my Canadian friends, this is for the index in USD, not CAD. So what do these massive drawdowns mean in practicality for you and I? We'll look at these underwater periods for those 4 massive drawdowns. The dot-com crash started in 2000 and ended in 2015. 1 month shy of 15 years. Think about that, guys. Checking your portfolio every month for 179 months and seeing it down. That's not fantasy. That was the reality for all those holding this index. Even the most recent drawdown started in 2021 and lasted for 2 years and 1 month. For some, even that short downturn and recovery is hard to hold through. And in the event you are retired, to sell at a loss throughout that entire period. Could it get even worse than that? No one knows the future. But try to imagine how it would feel to watch, say, your $1 million NASDAQ 100 tech portfolio drop to $170,000. And to wait and wait. Imagine if you were retired. Would you be able to stomach selling at any time during those 15 years? The real risk isn't volatility itself. It's why it has also had these incredible returns. It's abandoning your strategy halfway through the pain, or in the event of the dot-com crash 15 years later, to only miss out on the crazy run that's happened since then. Since QQC is so new, I use QQQ's Morningstar rating. It rates it as a very aggressive fund with a portfolio risk score of 82. It has an above-average risk and a high return compared to its category. Its standard deviation over the last 10 years is 18.7. Not to be forgotten, other risk factors mentioned in the prospectus. The big ones are the currency exchange rate risk, since we are dealing in CAD when the index is in USD. Tracking error risk, and foreign investments risk, since this fund is US dominated. And the biggest risk, in my opinion, is the sector concentration risk. QQC invests a significant portion of its assets in the technology sector. It has a heavy concentration from the technology industry. And the technology industry is so competitive. Technology firms can experience rapid growth or rapid decline in such a short period of time. And they also have short operating histories and short product life cycles. That's a lot of shorts. They may have limited product lines, limited markets, limited financial resources or personnel. Tech companies are also heavily dependent on intellectual property rights and could be adversely affected by the loss or even impairment of those rights. The market value of companies in this sector may be affected by these factors more so than other sectors. Hopefully this discussion on risk hasn't scared you away from QQC, nor the performance convinced you to blindly FOMO into it either. Because like most investments, reality sits somewhere in the middle. Now let's recap. QQC is the Invesco NASDAQ 100 Index ETF that gives Canadian investors exposure to 100 non-financial companies listed on the NASDAQ stock market based on market capitalization. The index has performed so good over its 55-year history. However, QQC comes with a medium to high risk rating because of its high volatility. Now, despite all of the volatility and concentration risk we discussed, there's still a very strong argument for owning QQC long-term. And honestly speaking, for the right type of investor, this ETF could make a lot of sense. QQC may be an excellent ETF for investors who truly believe the future of the global economy will continue to be driven by technology, AI, cloud computing, semiconductors, and other digital platforms. Because this ETF is not just buying tech, it's buying dominant companies that have become deeply embedded into modern life. And there's a very rational argument that companies like Nvidia, Microsoft, and Apple could continue growing for many years to come. QQC may also appeal to Canadian investors frustrated with the slower growth profile of the TSX, which is heavily concentrated in banks, pipelines, telecoms, and utilities. This ETF offers exposure to innovation and global growth trends that simply barely exist in the Canadian market. Let's be honest, guys. And concentration is part of why the returns have been so strong. Broad diversification often dilutes exposure to the market's biggest winners. But this ETF only works if you can emotionally handle the high volatility, the massive drawdowns when they do happen. Ideal QQC investor is someone who thinks in decades, not months, and understands that higher returns usually come attached to higher emotional discomfort and even pain for many years. Because many investors love growth investing when it's hot until it's not. But on the other hand, this ETF can become extremely dangerous if your behavior and risk tolerance don't match the volatility that comes attached to it. Because this is where investing stops being math and starts becoming more about psychology. QQC may not be suitable for you if you are chasing recent performance without understanding the risks. A lot of people discovered this ETF, this index, after massive gains, but historically, that's often when investors become overly optimistic and underestimate how brutal drawdowns can become, as we've seen. And this is where behavior matters more than theory, more than what we intellectually understand. Many investors think they can handle volatility during bull markets, but watching your portfolio fall 35% while financial media screams about a tech collapse is a completely different experience emotionally. I've been there, done that. QQC also carries meaningful concentration risk. Even though QQC holds around 100 companies, a huge portion of the fund depends on a relatively small group of mega cap tech stocks continuing to dominate. And while these are phenomenal businesses can still become overpriced. Great companies do not automatically guarantee great future returns, and great companies do not remain great companies forever. QQC may also not fit investors who need a stable portfolio with low volatility, are close to retirement or in retirement and already own heavy US tech exposure through funds like VFE or VEQT. It also isn't a fit for you if you panic sell during fast corrections or big black swan events like we've seen. Because ultimately, the biggest risk with QQC is not necessarily the index itself. It's investors buying a highly volatile growth fund without realizing how psychologically difficult high volatility growth investing can become during bear markets. And if after all of this you're thinking, I like the US market, but I want something a little more diversified and easier to emotionally handle, then check out my deep dive on Vanguard's S&P 500 Index ETF VFE right here.